Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Now joining us, Neil Dutta, Renaissance Macro, for too short a visit. Neil, do you still keep a constructive view on the American economic experiment?
Well, that's a great question, Tom. I do think the trade-offs are getting a little bit more challenging here for the Fed. My view is that inflation is likely to moderate over the next several quarters, okay? And if the Fed is skittish about recalibrating policy, given the coming slowing in inflation, then that would make me a little bit more concerned around the economic outlook. So that's kind of where I'm at. I think the trade-offs are not as obvious as they were a year ago. We look at the labor markets, Tom. If you look at average hourly earnings, I mean, people talk about stubborn or sticky prices. Well, wages are a very sticky price in their own right, and wages have been slowing quite meaningfully, over the last several months. If you look at the 3-month rate of change in average hourly earnings, it's running below 3% at an annual rate.
Paul, moments ago, Ian Ling and BMO Capital, real question is real spending.
Real spending.
That goes to that spending data.
Well, my spending is real, I can tell you that. Neil, talk to us about this 2% inflation data point that the Federal Reserve talks about as a target. How hard of a target is that? Should it be? Why can't the world live with, 2.5% inflation, 2.75%? How do you think about that?
Well, I think the Fed can live with that. I mean, they've signaled that they're willing to cut with inflation rates above that. I do think that the 2% number, that's a not necessarily a right here, right now target. It's just, kind of a point in time. We want to be moving towards that, in that direction sort of thing. That we've litigated whether that's the right number or not. It is what it is. I think for the Fed, it just needs to be moving in that direction in order for them to feel comfortable with easing.
Why is this 830 PCE deflator important? Except for the Fed cares. Why is this inflation series more important than 14 others, Neil Dutta?
Well, remember, Tom, and we have, in economics, you have often different ways of measuring the same kind of concept. Right. You have PCE and GDI, you have PCE and CPI, and the PCE number, it just covers, it has a much wider scope, right? That's why, unlike CPI, 40% is not shelter, right? I mean, because it has a much wider scope. But also, it looks at things covering payments made on behalf of individuals. Right. I mean, CPI only looks at out-of-pocket expenses. So I think one way of thinking about it is CPI kind of reflects what people think they spend their money on, and the PCE data reflects what people actually spend their money on. And I think that's one of the reasons why the Fed is looking at PCE.
Neil Dutta, does a negative statistic for inflation-adjusted personal spending, is that a precursor for inflation-adjusted negative wages out into the rest of 2024?
Well, I mean, to me, the data on real consumption is a reminder that growth is not getting away from the Fed. Going into the year, Tom, I mean, there was a lot of enthusiasm for economic strength. I think the consensus has largely adjusted to that, right? I mean, we went into the year very downbeat on growth as a consensus, and now people have adjusted, I think, to where they should be. And you're going to likely see a more mixed data flow now, because people generally speaking, have adjusted. I mean, growth was never going to be as weak as it was, as people thought it would be at the end of last year. Now we're kind of more in the 2 to 2.5% camp. So you should expect to see a more mixed kind of data flow relative to consensus now. But yeah, I mean, it just demonstrates that growth isn't getting away from the Fed. And when you think about consumption, remember that in recent months, we had seen a bit, I think before the revisions, I mean, we did see a meaningful decline in the savings rate. So there's a limit to how much you can draw down savings to finance consumption.
Right.
So, you'd expect to see consumer spending follow the growth in incomes more so. And, as I mentioned, wage growth has been moderating. So it's not all that surprising to see consumption, slowing a little bit here.
Key economic data. We're commercial free for this hour. Paul, why don't you continue with Mr. Dutta?
So, Neil, I guess if you look at this data, I mean, there's certainly a camp out there that I think would look at this data and kind of what we've seen over the last several months and say, my Federal Reserve can stay right where they are. They don't need to do anything here. Let's let these higher rates for longer do their job in pulling inflation down. How do you think about that?
I mean, I think you want to put that argument on as short of a leash as possible.
Okay.
I think that's, frankly, you never have as much time as you think. The risks with the economy are always nonlinear in nature. I'll just leave it at that.
Yep.
I think it's frankly dangerous. I mean, as a policymaker, your job, I mean, you're not a business economist. My job is to try to position clients for upside. Their job is to try to protect things from the downside. It's a risk management job. Okay. And what we know, I mean, core inflation came in on the nose, 0.2. I think it was 0.25 if you round it out to the 2 decimal points.
Oh, listen to you.
And I remember Waller in a recent speech talking about, I look forward to the day when I don't have to, look at it like out to 3 decimal places. That might actually happen sooner.
Okay, but this is a final question, Neil Dutta. This is really, really important. As you say, we've gotten out to 3 decimal points. I'm as guilty of this. The only one I know doesn't go to 3 decimal points is Lisa Mateo.
Right.
I mean, she's the only one I know.
She knows.
Neil Dutta is just simply the great, great call here of my Economist of 2023 is you said, I'm sorry, productivity is there, animal spirit's there, and we will clear markets to continue to prosper. Have you changed your tune at all?
Well, the only thing I have a real bone to pick with is on inflation. I think there's not as much upside to growth estimates. There's plenty of downside to inflation estimates relative to the consensus. So the consensus has come closer to me on the economy, but I think moved further away on inflation. And so for me, I think the momentum under inflation is lower. I think core inflation will, I mean, you can't rule out a 0.1 a couple of times here and there between now and the September meeting. You can't rule that out. And once that starts to happen, look for the bond markets to rally. So I think if I had to pick, I mean, as a market economist, stocks or bonds, I would pick bonds because either growth is steady and inflation slows, in which case bond markets rally, or growth starts slowing and inflation will continue to slow, in which case bonds rally a lot. So there's an asymmetry here in the market, I think, in favor of fixed income.
Neil Dutta, thank you so much. Really treasure the view here at 8:30 on Fair. Of course, with Renaissance Macro, look for Mr. Dutta and Jeff DeGraff's good literature. You'll see that on Twitter and LinkedIn as well. Francis Donald joins us now from Manulife Investment Management. Just wonderful. We did a great panel in Toronto. It was on fire.
Nice.
Francis Donald, from that panel in Toronto, when I went and saw the New Jersey Devils play the Toronto Maple Leafs, thank you, Redo, keeper of the Amex, for that. Francis, from that panel you and I did with David Rosenberg 2 months ago, how has your view changed?
It hasn't. Actually, I just looked up on ChatGPT. Give me examples of words for periods without any action that is temporary, because I was trying to come up with a clever way to say we're in a holding pattern, Tom. Especially in the United States, we are waiting for more information. Was Q1 inflation temporary? Where will jobs go? The balance of risks is that jobs deteriorate from this moment forward, but we got to get that June, July, August data. The Fed is not going to be cutting before September, but we need more information. And so week to week, it's bits and bobs on the U.S. economy. Now, that's true for the U.S. It's not true elsewhere. We had big PCE number this morning in the U.S. We're not talking about that on our team over at Manulife. We're talking about intervention in Japan. Might seem small, huge downward revision on Canadian GDP. Canada escaped a recession by a decimal point in Q3, Q4. We have the ECB cutting next week, the BOC cutting next week. There's a lot of movement in the world, but not so much in the U.S. I think that's the more interesting macro picture right now.
We're getting onto a late jobs report, June 7. The survey's still 180,000. I'm sorry, Francis, 180,000 non-farm payrolls is still maybe not robust, but I'm going to borrow from Bob Sinch, a solid American economy?
Yeah, it's not a problem. Not a problem. And this is the big issue facing the Fed, is that the balance of risks is tilting towards an acceleration of weakness in the U.S., but inflation is still above target and the job market has not deteriorated. We like to say on our team, when the Fed starts cutting rates, you won't be asking why. If the Fed cut rate in the next 2 months, we'd all be shaking our heads saying why. So they just don't have the data. Now, that said, when we forecast what's ahead, we think they will have enough data by September, but they don't have it now, which is why they can't cut in June, July, and they have to wait.
Thank God we're commercial free this hour with key economic data and the markets lifting off it. SPX up 17 points now, first green in days. The live chat on YouTube is lit up like a candle. Paul, this is too much. Brent, thank you so much. Alcohol-free Corona is Sprite.
Yes,
there you go.
That's exactly.
There's the marketing. Brent, thank you for that wisdom.
So, Francis, here you talked about the B of E cutting rates, the European Central Bank cutting rates soon. I mean, a lot of folks out there, Francis, would say, my Federal Reserve is behind the curve here. They should be cutting now. What do you say to those folks?
Well, I say this is actually very atypical, and I think that's what's causing problems. Historically, the Fed goes first, everybody else follows, EMs go last. The cycle has been so fundamentally different. EMs are almost done their cutting cycle. We have several developed markets who are cutting ahead of the Fed. I think this is actually creating some problems, and I was talking to my team today. We're so used to saying the Fed only cares about what's happening domestically, and the Fed is the ruler of all other central banks. But the Fed is also going to care about some of the global disruptions that is coming from them being last or near last. We've got the RBA and the BOJ, of course, that are still on the hawkish glance. And so the number one question that I get is, what are we doing with currency risk in countries that need to cut rates because their economy is weakening but can't diverge too substantially from the Fed? So I think we might see some subtle, or I'd like to see some subtle references from the Fed of some of the chaos that's being created by the Fed going later. At the end of the day, though, these central banks have their own domestic mandates. The Fed doesn't have justification to cut. These other central banks that are cutting absolutely have to get on the ball, or else they're going to risk bigger recessions and potentially larger rate divergences.
Well, that's kind of where I want to go, Francis. I mean, there are a lot of folks out there that are saying, boy, the more this Fed waits here in terms of cutting rates, the more we raise the risk of an accident happening in the marketplace or something worse. What's that risk to you? Yeah, I pay attention.
Was Dell an accident waiting to happen?
How about those guys? Yeah.
There are a lot of things that are different in this post-COVID economy, but I am still a traditionalist in the sense that I think basic economic relationships hold. Higher rates exist to bring down demand, and we have seen already a few small accidents that occur. But I think we bury the lead a little bit when we hear economists talk about, it's going to be a soft landing and the Fed's only going to cut 3 times. Well, the question is, if they don't cut pretty significantly, what does the next recession look like? Maybe it's not a 2024, maybe it's not even a 2025, but that recession is likely to be much worse.
Thank you, Francis Donna. What's great, I mean, our bookers, they have it nailed. So I sat on my cell phone in shock over these announcements. The speed of the verdict for me as an amateur, all 34 counts for me as an amateur. And I turned to the team, we're texting back and forth like everybody does today, and there's only one person I wanted to talk to. Simply put, is a Ute out of Amherst, UMass Amherst in Harvard. He worked with Leon Jaworski. That's all you have to know. Yep. Nick Akerman joins us now with decades of experience in the American judicial system. Nick, my first question is simple. How will this verdict affect the other matters of litigation that Donald Trump faces?
I don't know as if it will affect it directly. It really, right now, those other matters have been delayed for various reasons. The big item is in Washington, D.C. and Atlanta, where they're waiting to see what the Supreme Court does with the immunity argument that Trump set forth. So I think that one really hinges on the immunity. But I think it does cast a whole different pale on these other cases, which most people have said are probably more serious in some ways, although I would agree with that. But it certainly puts the pressure to get those cases moving and get them into court and tried.
What does an appeal court look like? I think even if we didn't have TV cameras there, we had the great artist sketches, and I think we know what, Nick, Paul Drake, Perry Mason, I got it down cold. But Nick, what does an appeal court actually look like?
Well, you're saying an appeals court to appeal this conviction.
Yes. What does the actual physical, what do you do at an appeals court?
Well, what you do is you go up to, there's two podiums, one for the person who's appealing and the other for the person who's opposing the appeal. In this case, it'll be the prosecution opposing the appeal, and it'll be Trump making the appeal. And you've got, in this case, in the first department, there'll be 5 judges that will hear that appeal. And so the only argument they really have is to try and somehow dredge out arguments based on the law to appeal this conviction, because essentially once you have a jury verdict and they've decided on the credibility of the witnesses and the facts, there's not much to appeal after that. And I don't think there's much to appeal either on the legal portion of this. So I don't think this appeal is going to go very far for Donald Trump.
All right, Nick, then let's turn to the sentencing aspect of this case, July 11th. What are the scenarios? What are the most likely sentencing scenarios, Nick?
Well, before January 11th, there's going to be a couple of reports that you're going to see. I guess we won't see them until the time of sentencing, but probation does a report that's provided to the court. Both sides provide sentencing memoranda to the court. The question, of course, is whether or not the DA's office asks for jail time. And if they do, whether or not Judge Merchan will provide jail time. My opinion is that based on at least the fact that Michael Cohen served 3 years for these violations, and that Alan Weisselberg, the CFO of Trump Org, who was instrumental in setting up the phony corporate records on this and the payments that went out to reimburse Michael Cohen, he's already served 3 months in Rikers Island for unrelated matters, and now he's serving 3 months, another 3 months in Rikers Island for lying, and it's pretty clear that he has not cooperated against Donald Trump. And I think the judge is going to have to consider that here are 2 people that were instrumental in this crime that did serve jail time, and I find it hard to believe that he is not going to feel compelled to give Donald Trump at least some jail time.
Wow.
In what way? I mean, I wish I could stop the clock here on the show. Nick Akerman, I can't. I mean, what is it? Weekend jail time? I mean, is it something creative and different? Or is it, are you telling me the former president of the United States could enjoy a month at Rikers Island?
Yeah, absolutely. I mean, I think what they'd have to do is create a presidential suite at Rikers Island because the Secret Service has to be there with him, obviously. But I think there is a very strong likelihood that he is going to be sentenced to imprisonment.
Will he be protected from other prisoners? I'll just be as direct about it as I can.
Absolutely. I don't see how in any way he can be put into the general population. I just don't see that happen.
What does he need to say at 11 a.m.? Nick Akerman, we're running out of time, unfortunately. What does the former president of the United States have to say at 11 a.m. to keep himself out of Rikers Island, Rikers prison?
At 11 a.m., I don't think there's anything he can say that's going to help him on that score. This is all going to be decided in the courts, just like the jury decided guilt or innocence. The judge is going to decide the punishment. And it's totally apart from anything that Donald Trump says at 11 a.m. In fact, if he says something that violates that gag order, he could wind up in jail a lot quicker, because now that he's been convicted by a jury of his peers, I think Judge Merchan's going to feel a lot more comfortable enforcing that gag order through imprisonment.
Yeah. Thank you for your service to Bloomberg with Bloomberg Law with June Grasso and Balance of Power as well. Yep. Nick Akerman working with Leon Jaworski a few years ago as well. Betsy Stevenson and Justin Wolfers out in Ann Arbor have a textbook out which melds public policy into economics like nobody. About 10, 15 years ago, Rick Mishkin over at Columbia did the same thing. Living that reality is Jason Furman of Harvard University. And all I can say, folks, you sit there and go, geez, I wish I had a briefing like they have at the White House, or I wish I could just for 10 minutes sit in the back row of Ec 10. I won't ask any questions, but I just want to know what's going on. No one is out on Twitter conveying information about this post-pandemic time like Professor Furman. He joins us now from Ec 10 at Harvard University. Jason, first of all, congratulations on your Twitter feed. Are you doing this, or is this a host of young freshmen at Harvard?
I'm doing it. I have somebody that helps me with the charts.
There we go. There. It's like Liz Ann Saunders at Schwab.
Yeah.
I mean, the kid from Pepperdine's doing it. I mean, not Liz Ann. Someone helps you with the charts. What's the most important chart right now? I'm going to go core services X something. What's your most important chart, Jason?
I think probably core PCE market-based. I haven't liked the imputed stuff being in there for a while. Back in 2022, it was lowering inflation because the stock market was falling. Now it's raising inflation because the stock market is rising. So I think more of a focus on market-based inflation is a good thing.
How do you describe, I mean, you're going to be, you're at Harvard now, but if you were down at 1600 Pennsylvania Avenue, you're sitting on the couch with President Biden and you're going, look, people are getting buried by home insurance. Forget about this rent OER stuff. The fact is there's selected levels way above 2019. What would you advise President Biden?
Look, it's tough. I mean, inflation, he doesn't have a whole lot of control over. For him, there's the fiscal side. Most of that's with Congress. There are things like student loans that may end up costing $1 trillion, which are going the wrong way in all of this. But the most important thing he needs to think about over the next 5 months is he doesn't have a whole lot of control over this. The economy in some respects is really, really good, but people aren't wrong to be frustrated about the pace of real wage growth, the growth of prices.
All right, Jason, let's take a look at the consumer here. We had personal income come in at 0.3% positive today, right in line with expectations. Personal spending, a smidge light, 0.2%. But how do you see the consumer out there? A lot of folks are talking about a couple different consumers out there, actually.
Yeah, we're starting to see a little bit of slowing. On a real basis, consumer spending fell in April. It had been really strong in February and March. If you look at the year as a whole, it's up at about a 1% pace so far. Consumers, what kept us out of recession last year as the Fed raised rates over and over and over again, they're relaxing a little bit. The saving rate is around 3.5%. That could stay that way for some time. I don't think it can stay that way forever.
All right, so we got some more inflation data today. And Jason, presumably this Federal Reserve will be also looking at the employment environment. That seems pretty solid as well. We'll get some more data next week, but the labor market seems pretty solid as well.
Yeah, I mean, that's the thing. That's part of what's going on with rate cuts right now, is there's not much reason to cut them. Economy's growing well. Job growth is well. We're more nervous about inflation than we are comforted about inflation. So why move? And I think it's going to take a while for the Fed to be reassured. Back in December, they were looking at 6-month core PCE at a 1.9% annual rate. Now it's a 3.2% annual rate. This worm can turn very quickly. I think it's going to take a while before they can feel reassured enough to cut rates.
Jason, I want to conflate two questions here, which is unfair to you, but no one can handle it like you. You have led the charge with comparing 1 year, 6 month, 3 month annualized, et cetera, parsing out the timeline that we should choose to study inflation. In addition with this is the raging battle over this series or that series or this trimmed or that, Cleveland CPI, Furman CPI, whatever. Conflate those two ideas together. What's your best picture of how to measure inflation?
Look, I've been having fun with something I call the ecumenical underlying inflation measure.
Sounds like fun.
And I take, 8 different ways to measure inflation. I look at it over 3 different time horizons. That's 24 different numbers. And then I just take the median of all 24 of those. And, statistically, it actually works pretty well. It gives you a pretty good sense of what underlying inflation is. All that said, if I had to pick a conventional number, looking at 6-month core inflation is not a bad way to understand what's going on.
We don't want any East Ecton gossip here. Does Mankiw believe in the gospel of Furman ecumenical inflation?
He's on the record saying he thinks inflation's coming down this year. He's optimistic about shelter growth slowing. He's said that before in public. I'm less sure that there's that much more slowing from where we are now. And I think there's some other shoes to drop, like goods prices aren't going to keep falling the way they have over the last 6 months.
I'm sorry, it's like Jeremy Bentham, his head's bronzed in some museum in England somewhere. I mean, we're back to unitarian inflation here with an ecumenical approach.
Professor, there are a lot of folks out there in academia and in practice in the markets that say, forget about the first few months of 2024. Inflation's it's already whipped. We're in good shape. The Fed should be cutting now. The risk of not cutting is too great. What do you say to those folks?
I say that the inflation risk is quite asymmetric. They might be right. There might even be like a 40% chance they're right, but there's a 30% chance that inflation's going to be well above 3%. At which point we're in a really unacceptable place in terms of the Fed's credibility. So you do that type of risk analysis, and it says don't cut. In general, the best forecast for the economy is that it's going to keep doing what it's done. And growth has been strong. Job growth has been strong. That's my best guess going forward. On the other hand, inflation's been elevated, and that probably should be your best guess going forward. So we're at an asymmetric place on the dual mandate right now.
I mean, Professor Furman, you're such a hitter. Did you do a speech at the University College of London, and did they show you the taxidermied head of Jeremy Bentham? Is that where we came up with ecumenical inflation?
I have not met Jeremy Bentham alive or dead.
There you go. There's news you could use from Bloomberg News today. Jason Furman, thank you so much. And I can't say enough, folks, about his and his team's effort out on Twitter. Seriously, it is the best graphical presentation of where we are. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.